Geopolitical shockwaves are hitting global markets right now. Israel has struck Lebanon, killing 8 people, and the United States Navy just rescued a helicopter crew from the Strait of Hormuz. 2 incidents, 1 week, and both have direct consequences for your investments, your ETFs, and every interest rate decision the Federal Reserve will make in the months ahead. If you have money in the stock market, and most of you watching this do, you cannot afford to ignore what is happening. In this video, you'll discover exactly how Middle East escalation historically impacts the S&P 500, what happens to oil prices when the Strait of Hormuz is threatened, how the Federal Reserve responds to geopolitical inflation shocks, which ETFs tend to hold up, or even gain, during periods of conflict, and the specific steps you should consider taking in your portfolio right now. This is not fear-mongering. This is data, history, and strategy. Let's start with the geography, because location is everything in this story. The Strait of Hormuz is a narrow passage between Iran and Oman, roughly 21 miles wide at its narrowest point. According to the U.S. Energy Information Administration, approximately 21 million barrels of oil pass through that strait every single day. That represents about 21% of total global petroleum liquids consumption. When a U.S. military helicopter crew requires emergency rescue in those waters, global energy traders do not sleep. They reprice risk immediately. Brent crude futures moved on the news. And when oil moves, inflation moves. And when inflation moves, the Federal Reserve pays attention. That is the chain reaction every investor needs to understand. Now let's talk about the Israeli strike on Lebanon. 8 people killed in a targeted strike marks a significant escalation in a region that was already fragile. Historically, when conflict intensifies in the Middle East, 3 things happen in markets almost without exception. First, oil spikes, we covered that. Second, the VIX, which is Wall Street's so-called fear index, climbs. During the initial outbreak of the Russia-Ukraine war in February 2022, the VIX surged above 37. During the Gulf War in 1990, oil prices doubled in under 4 months. Third, safe haven assets attract capital. Think U.S. Treasury bonds, gold, and the U.S. dollar. The S&P 500, by contrast, tends to experience sharp but often short-lived pullbacks in the early stages of geopolitical conflict. The key phrase there is short-lived. Data from LPL Financial analyzing 22 major geopolitical events since World War II found that the average S&P 500 drawdown during these events was just 4.8%, with the market recovering its losses in an average of 47 days. Volatility spikes. But it does not last forever. So what does this mean for the Federal Reserve and interest rates? Here is where it gets complicated. The Fed is already navigating stubborn core inflation. As of the most recent CPI data, core inflation remains above the Fed's 2% target. An oil price shock driven by Middle East escalation creates what economists call a supply-side inflation surge, and that is the most difficult type for central bankers to manage. They cannot lower interest rates to stimulate a slowing economy if inflation is simultaneously being pushed higher by energy prices. This dynamic, called stagflation risk, is exactly what spooked markets in the 1970s. The Federal Reserve has explicitly stated it is data-dependent. A sustained oil spike of 15 to 20% could delay any anticipated rate cuts well into the second half of the year, or beyond. That matters enormously for bond ETFs, growth stocks, and real estate investment trusts, all of which are highly sensitive to interest rate direction. Now let's talk about what actually holds up and what can even gain when geopolitical risk spikes. Defense sector ETFs have a long track record of outperforming during conflict escalation. The iShares U.S. Aerospace and Defense ETF, ticker ITA, gained approximately 18% in the 12 months following the start of the Russia-Ukraine conflict. Energy ETFs similarly surge when oil prices spike. The Energy Select Sector SPDR Fund, ticker XLE, was the single best-performing S&P 500 sector ETF in 2022, returning over 65% while the broader index fell nearly 20%. Gold ETFs, such as the SPDR Gold Trust, ticker GLD, serve as a traditional hedge. Gold crossed $2,300 per ounce in recent trading, reflecting growing demand for safety. And short-duration Treasury ETFs offer stability when equity volatility climbs. Knowing these categories exist is not enough. Knowing when to rotate into them, and by how much, is the discipline that separates reactive investors from strategic ones. Here is what you should actually consider doing right now. Review your current equity exposure, particularly in high-growth, high-multiple tech stocks that are most sensitive to interest rate increases driven by an oil shock. Consider whether your portfolio has any energy exposure. Even a 5 to 10% allocation to an energy ETF has historically provided meaningful inflation protection during periods like this. Evaluate your bond duration. Long-duration bond ETFs suffer when rates rise unexpectedly. Short-duration ETFs are far more resilient. And do not ignore cash. In a high-rate environment, money market funds are currently yielding above 5% annually. That is not nothing. Rebalancing is not panic. It is preparation. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before making any investment decisions. The situation in the Middle East is fluid and fast-moving. Markets are repricing risk in real time. But history is clear. Informed investors who understand the mechanics of how geopolitical events ripple through oil, inflation, interest rates, and the S&P 500 are far better positioned than those who react emotionally. Stay grounded, stay diversified, and stay ahead of the data. If this video gave you clarity, hit the like button right now. It genuinely helps this channel reach more people who need this information. Subscribe to YieldWire so you never miss a market update like this one. And check the link in the description below. We have identified a top-rated brokerage platform offering commission-free ETF trading that is worth a serious look for building the kind of resilient portfolio we discussed today. The link is down there. Use it. Your future self will thank you.